to look at how many litres of fuel you can buy for an ounce of gold, or how many, how many thousands of litres you can buy for an ounce of gold. And that idea where we said, if you're burning 20 million litres to produce 100,000 ounces of gold, which seems to be, looking at a couple of companies, that's sort of a metric. For about 2% of your production for the next 2 years, you could forward sell 2% of your gold for the next 2 years, and you could then hedge 60% of your oil at current prices.
This content is general advice, my opinions, and for entertainment purposes only. CFDs are high risk, past performance isn't reliable. I may be long or short CFDs and stocks mentioned. And stop loss haters, no one knows where the gold price is going. Up, down, sideways, back to front. But if there is one person I will ask for an opinion that I will hold very highly, it is Shawnee Russo from Noah's Rule. Mate, welcome back. It's been 5 months since we chatted, and it must have been a curse because gold has gone to shit since then. We chatted in Feb, mate. I think it was still 5,200 or so. Mate, here's the chart.
It was right in the final days of that rally before we had the big sell-off. That's absolutely right.
Yeah.
Thank you for your kind words, and it's nice to catch up, mate. I've been enjoying your new show. It's great.
Oh, it's very. So am I, mate. Thank you very much. Now, mate, you said, I guess last time, I think I was saying, this is funny to say now. I was asking you, right, are we going to go? We're sitting at about 5,000. Are we going to go to 6,000 or 4,000 first? And it's obviously gone to 4,000, and it is now below 4,000. Mate, did it surprise you? Has it been this gradual grind that you saw coming? How are you following this emotionally?
Look, I'm not surprised at the prices that we see today, in the sense of, the market, after it rallied like it had the capacity to fall. It has the capacity to fall further. I mean, if you think about the number of days in the history of the world, the gold price has been above the levels that are prevailing today. It's a blink of an eye, right? So, all of the people in the mining industry, they love to talk in geological time. Well, in geological time, the gold price has been above $3,000 an ounce for a nanosecond, right? So, and similarly for Aussie dollar gold above 4,000. So, I'm not surprised. I was a bit surprised by the speed with which it fell back in February, but I shouldn't have been, really, given when I was talking to you and you got the chart up there of the death zone. We chatted last time and I said I'm really struggling to try and find an analogue in my working life going back to 84, and I've gone back and looked at the 70s and spent some time looking. So we talked about that last time. And one of the reasons we did that is because we found that the price was consistently more than 80% above the 200-week moving average and more than 20% above the 200-day. And when we went back to find other occurrences, we could only find them there, those red lines, in the early 1970s, and then right in the late 1970s, 1980, when we made that all-time high that kind of really dominated my career for the first 25 years in terms of, that famous 800 high we questioned if we'd ever get back to when we were at 250. So we were above that, and I think the example I used was like a plane with afterburner. Aerodynamics didn't apply anymore. It was a rocket, but you run out of fuel pretty quickly. And you, I think, made the point. You go, well, the moving averages are going to run fast because the price is high, so it's going to have to run even faster to keep ahead. And it did until it didn't. And what surprised us is we broke out of the death zone, and literally within 2 days, we were back at the 200-day moving average. So if you remember that first sell-off we had, the really sharp sell-off and then the big bounce, it literally closed out of the death zone. And we call it the death zone because, mountaineers above a certain altitude, they all seem to die above their lack of oxygen. So whatever it was driving it just changed. And we weren't surprised that it would retrace the 200-day moving average. That's a pretty logical place, and you can look on this chart all through the 2000s. Every major sell-off retraced to that green line, which is the 200-day moving average. It's sort of the testing point. I was surprised it got there in 2 days. And then it bounced, bit of a dead cat bounce, and now we've come through it again and we're below it. And, Paul Tudor Jones is a very famous hedge fund manager, and he always talks, Matty, about the fact that you don't ever want to be long of anything that's below the 200-day moving average, and don't be short of anything that's above it. As a very simple guide. It's slightly more complicated than that, but at a very simple level, that is some of the richest information you can have in a market, is just where it is in relation to that. And it's not the be all end all, but it's one very important element in how I look at the market and all markets. That's for sure.
Yeah, it's just the pretty simple maths. It's going to at some point come back to that moving average if it's either side of it. But Jesus Christ, if you were really going off this death zone thesis, like you look where that has come in here, where that death zone commenced, and if you go back to the actual gold chart, like imagine if you had that view at 4,600 which was January, and then that's when it went to 5,400. So that was nearly 20% in that very, very short period of just after Christmas. And God, you could have burnt yourself if you were going the other direction.
Absolutely. And that's why our position was really much with the clients that while this continues, don't fight it, but be ready. But most companies, most of the companies just don't have a predilection to want to hedge anyway in the current environment. So, but certainly to the extent that we were trying to get people to do it, we said, well, when this ends, you've really got to be very mindful of that. And we certainly switched in our kind of weekly advice from always deferring sales to trying to sell early in the period when that happened. I think the most important thing on this graph, as I would look at, is to try and we'll touch in more detail, is this the early 70s? If the 70s is even a reasonable analog, and I think it is, given inflation and other things that are going on in the world, is it the early 70s or late 70s? Well, either way, it's still pretty scary, because if it's the early 70s, remembering, as we just touched on last time, we halved after these events in the early 70s from 200 to 100 and didn't get back to above 200 for 3 or 4 years. So again, we've said to our clients, Matty, when a high is made in this condition, and the high, the other nearest by analog would be 2020, we would not be surprised that the market trades sideways for 18 months to 3 years before it makes a new high, if indeed it makes a new high, and that the average price over that period may not be too different to the 200-day moving average around the time it breaks down, which, is higher than here, obviously. But if you look back in 2020, after the high in that sideways, you look 2011, 12, and you look at all of the peaks all the way up, and there's probably a better chart in a minute to look at them in more detail when we zoom in onto the 2000s. But it wasn't at all unusual in 2006 and 2008 that we had these kind of sell-offs, fell very quickly, and then took a long time to consolidate and regroup, and before you took out the high, and it was often 18 months to 2 years. So I have no issue with that being a kind of the most optimistic case that most producers should run on. So, and here's another interesting thing. So this is at another level, Matty. This is our scoring system, where the yellow dots mean the positive score or negative score is, above 4 or below -4, and the red is above 5, and it can only go to 6. And I described last time to you that periods when you got a red dot is when buying just overwhelms selling in the marketplace. People wake up in Asia, they want to buy gold. They buy, the Japanese buy, the Chinese buy, the Indians buy, the Middle East buys. As we go around the clock, the Americans are buying. Producers are selling into it, but every day the buyers come back and they want more. You have that kind of bit like in junior stocks. You know what it's like. There's a period when everybody's got to own it until the one day you ring up and you want to sell it and the broker says you're a day too late, mate. There's not a bid. And that, again, it's that kind of the afterburner comes off. So, we've often said to clients, if it's starting to rally, if it's not yet red, it's not yet the end. Like all these rallies end with red scoring, the significant rallies. But once the red ends, you've got to be mindful. And so you can see there in 2006, we had a very steep run up, and then it took really, and that was, well before the GFC, and then took the lead off. Now, the red box above talks about that period from, late 2005 to 2006. There was 3 periods of those red dots with a couple of gaps in the middle, but I've grouped them up, and it was 27 weeks, and the market ran 47% to the high, and it was 35% higher at the end of that 27-week period. Interestingly, we just finished a 28-week period, up to the recent high, where the market ran 47% from the beginning of the red dots up to the high. And when it finished, it was 40% higher than where it had started. All right. So we don't know how many weeks high until the next high, but you can see there at the end of that 2006 period, it was 71 weeks. And in some of these others, it's been as long as 173 weeks after the 2020 high. So that's 3 years. And of course, in 2011 was nearly 10 years until you broke that high. So these highs that have finished in these red dots at our scoring of kind of these extreme situations, none of them as extreme as the one we've just had. None of them match the 70s other than the last one. But the 2006 rally is just as strong. So what's the positive to take away from that if you're looking for positives? I hear lots of people going, that's it, gold market's dead, parabolic rise, market can't sustain that kind of move without a really substantial fall. And they go, okay, well, it did in 2006. We had just a similar, and I think percentage moves are all that are important, Matty, not dollar.
Yeah.
Moves, right? I think percentage moves are far more important. And so this was as extreme as 2006. 2006 didn't go as far below the 200-day moving average as we have already. It's looking a little bit more like 2008. But either way, the reality is most traders are just going to go away now and not play with gold until they see it absolutely on sale, like some big capitulation low, or it gets back above the 200-day moving average. Most momentum traders will just go off and do something else.
Yeah.
But the rally in that sense it's the kind of rally that, that's why we're saying to our clients, plan for 18 months to 3 years of sideways. If it's faster than that, that would be great. But, you got to kind of live within your means. You've got to imagine it could be lower in the meantime. And I think the thing in the report we wrote today is of the ranges that we quoted of how low it could fall, there's still another 8 to 10%. Easily this market could fall before you would say it's not on a bungee. Like the bungee could stretch another 5 to 8%. And then we could bounce. If it much more than that, you'd say, well, the bungee's kind of broken. It's probably there's a bigger problem at hand.
Because so when you're talking about like the theory that like, look, this could be sort of range bound for 1.5 to 3 years, is this purely from a historical, technical viewpoint of like history and graphs? Like, do you bring in any like fundamental macro views of US interest rates, debt into anything? You're just purely looking at the statistical and technical side?
That kind of view is just looking at what has happened after these kind of scoring events in the past and said that's the time it takes to rest and repair. And, that's just been a bit what we've seen, Matty. And that's the reality. Now, I'm no macro guy, but as you know, I do put a lot of stock in gold as it's trading relative to equities because I think that's very important. And we've got a chart on that in a minute. And I think, I said to you when we were chatting last, what could kind of bring this undone? You asked me what could bring this undone. And I said, I think we have some event. Didn't imagine Epic Fury wasn't on my dance card.
Well, we could have some later.
We could have an event and the dollar would go up. And I said it's far more likely that gold's going to come unstuck because the dollar goes up than gold starts to that equities start to really outperform gold in a meaningful way. And indeed, that's what has happened. And when we get to our dual headwinds, dual tailwinds chart in a minute, it was the US dollar that really took the punch bowl away from the party more than anything else. Like gold can rally against a rising US dollar, but when dollar rises in a crisis, that's a big part of it.
Yeah. Your signature chart, mate, or I've seen other YouTubers use this chart. I'm just saying it it was it commenced with you. Let's just run. It commenced with Noah's rule. Sorry, I still know the rule. I still know the rule of Noah's rule, mate. The Dow gold ratio. Last time you said sort of, if you're below 10, bad things happen. We are sitting pretty close to 10 on the Dow gold ratio.
We've rallied up to 12.7 or thereabouts. So we bounced off that low. We had an extreme low that we went down. We briefly stuck our head below 10, and then it bounced quite hard. In the questions that so the Dow gold ratio, I look at a guy called Richard Russell introduced it to me. I used to follow his newsletter as an older guy, and he first started talking about it. Then Pierre Lassonde really popularized it. But basically, when it's rising, equities are outperforming gold, and no fund manager unless he's paid to be long gold, and you would, if you were a sensible fund manager, you change jobs. In a rising Dow gold environment, you go, general equities are outperforming gold. Why pay attention to gold? But in an environment where the Dow gold is falling, where gold is outperforming general equities, you'll find you get a lot of people who, even if they don't believe in gold, will come across to gold. So that's why I believe it's very important. So the 70s, Dow clearly outperforming gold, falling Dow gold ratio. And as I said to you, it tickles my fancy that the year I finished high school, it was 1-to-1. And I've said, even when it was at 40-to-1, if I'm careful crossing the road and I live a long life, I think I'll see close to 1-to-1 again in my lifetime. And that certainly still is my belief in terms of in the background of how I think about things and trying to, manage my own money and now investing for my first grandchild. So yeah, in my mind, I can certainly see the idea that can get back down to the bottom half of the page. But again, I think it'll be the next time we go through 10 that really things get interesting. Until then, it might rally. You asked me a question, Maddie, of all of the highs that we've recently had in gold, what does this last one feel the most like? And I'm going to switch it around a bit and say the one it feels the least like is the high, and the first real gold high I experienced in Christmas 1987, which, everyone was saying, strapping young man, we're going back to the 1980 highs. US dollar gold went to 500, Aussie dollar gold went to 700. Everybody who was anyone in Western Australia was building a gold mine, Bondi and all of them were there. And we had the 87 crash, everyone poured into gold, and then gold fell 40% in 1 year in $8 terms. And, anyone who wasn't hedged was out of business. And so that's the concern. The concern is that this high we've just seen is something like 1987 or something like 2011, because everyone remembers in 2011 that led to 13 and the big collapse, and again, a painful point. Now, I've circled those two in red because 1988 was a retracement in an overall uptrend in the Dow gold ratio. Gold had started to underperform equities long before 1987, 88, and that was, if you like, it was a bear market rally, and so it doesn't look like that to me. And 2011 was the end of a very, very long move from 40 to there. And the other thing that's really important about where that price goes out of that red circle and crosses the 200-week moving average, the Dow was making a new all-time high, only just recovering from the high of the GFC. All right. So in 1988 and in 2011, those periods, those highs that we made in gold were highs where people had rushed into the share market after a major share market collapse. And then the share market put the green light on and said, come back to me, I'm safe. And everyone just dropped, the Western guys, the tourists dropped gold again. I don't believe that at the moment that there's the similarities there necessarily. I still think people are talking about equities being in a bubble and maybe talking about that for a year. I mean, is it 1998 compared to 2000? Is it 2006 compared to 2008? I don't know. So I think I go back to it's more the little spike we've just had is more like 72 or 74, which is where we had those two red lines on the first chart, the death zones. Or it's like 2003 or indeed 2006. And I've just said to you, it was almost identical to the rally in 2006 in terms of percentage move and in terms of time. So, yeah, are we somewhere near there around 2006? Are we rallying up? Are we going to bubble under that 200-week moving average and then make a new low? That's why my view is, in some ways, stay away from gold. If you can't stay away from gold if you're in gold mining, but the average investor probably not going to pay a lot of attention till that either gets back to 15, if it gets back to 15, or it breaks through that low. But the next time it breaks through that low, you'd imagine it'd be on. But so my working analogues are probably 2006 and maybe 74. And 74 is scary because obviously we did have a 50% retracement.
Yeah, and that because you think of the bubbles they keep talking about at the moment, the tech bubble, which is the A2 tech stocks in the Dow, Apple and Microsoft. But you can imagine if a tech bubble bursts for whatever reason, it just comes. It's going to come out of everything, not just bloody AI stocks.
No, absolutely, Matty. And the S&P, you can, as we discussed last time, you can do this for S&P Gold and go on to X, and you'll find 1 million times. But I think we're in a downtrend. I don't think that my own personal view is that we're not in a situation where, we're going to have a massive change and this ratio start to go up in the way it did in the 80s or the way it did in 2012 to 2019. And as much as anything, this whole Epic Fury thing, and it shouldn't diminish it given how many people have died and whatever, but it's kind of a wrinkle in things. If you look at it, the broader thesis that there's more money being created than there is gold being created that we chatted a lot about last time. When this all dies down, the amount of money the Americans have spent on munitions, the amount of stuff they've destroyed that's been destroyed in the Middle East that has to be rebuilt. People are going to start printing money again, borrowing more money. So, the lower gold price goes, to my mind, the more value it is in terms of longer term potential, because the one thing I don't think that we're going to see in the near future is governments being more sensible. And if you do, you get thrown out, Keir Starmer or someone, wherever people turn up. Anyone who tries to get anybody that, that's going to be in some way spending less money, they don't last very long in the job. So I think, I don't see the broader thesis for gold has changed. It's just we've had a bit of a liquidity event. And if you think of all the people that are suffering from what's happening in Epic Fury, even down to the host, all the guest workers in the Middle East that send money home to other parts of Asia, all those people, they don't have money in the bank, they have gold that they save. If they're digging into their savings so they don't have a job or they're having less tourists or whatever happens, they're selling gold. So again, a bit like the Asian financial crisis, it's not surprising that, a lot of people are sellers of gold at the moment.
Yeah, and you think of all the investment that's going to come out of it, you talk about the negatives of the war, but that's spurring on. They're talking about building all these alternative pipelines to bypass the strait, to come out of Canada or Alaska. Sounds like the global investment's going to bloody turbocharge to de-Iran the place. Yeah, in a way.
Well, yes, absolutely, and. The reverse of globalization, it seems right there, and everybody wants to, it's going from just in time to just in case and all those other lines that other people smarter than me have written down. So, the broad thing hasn't changed. It's a timing thing. So that leads us to this chart, which I think is a beauty. And this, again, is really much drawing on our internal scoring. So, again, the gold price going right back. Those circles are the same rallies that I touched on in the previous graph. But for those people who didn't watch last time, and just a reminder, the colouring of the line is not anything to do with the gold price particularly, but the colouring of the line is when gold is when the US dollar index is negative, when the US dollar index has a negative background and the Dow Gold has a negative background, right? So that is dollar falling and gold outperforming equities, the line is green, and we call that dual tailwind. So when the US dollar index is trending lower and the Dow Gold is trending lower. Now, the second one obviously is partly to do with obviously the gold's interrelationship with equities, but it's been pretty good. And more importantly, dual headwinds is when the reverse happens. So if you've got a green background on the Dow Gold like we had in 2012 or we had in 1988, that would be the first step. And if you then had rising dollar, when those two things occur, then you have a red background. And certainly you can see there that you really don't want to be an investor in gold or running a gold mine if you can help it in most of those periods in the past where we've had dual headwinds, and particularly we've been under the 200-day moving average. And, in between the circle, I think it's 2002 and 2006 there, Matty, there's a tiny little fleck of red. There's this tiny little, like a couple of weeks where we had dual headwinds and the market said, no way. And then it took off, right? But really for that whole period in 2000 to 2011, it was one way, as it was from 77 to 2000. So we've got, we had dual tailwinds when you and I last spoke. We've lost dual tailwinds because the dollar index now has a positive score. So we've only got one. We're still outperforming the Dow, but the dollar's gone up. So it's gone back to being a blue line. We're happy with the blue line. We don't mind. Down below where you've got your arrow now, that's going down a level to the daily score. So the one up above is when we use the weekly score, long-term data going back for longer periods, come down into the weeds, into the detail. And what we see here is at a daily score level, the Dow Gold's got a positive score and the dollar's got a positive score. And we've got dual headwinds at a daily score level. And that is the precondition to actually having it switch over at the weekly. So why we look at that is to give us a sense of, is this a correction or something more? Now, you can see in 2020, we had that condition, the first sell-off after the high. And I believe right there where your arrow is now is the best analog for where we are right now.
Yep.
If you want to be bullish, it's hoping around here, but that fell about another 8% high to low than where we've currently fallen high to low. So, are we relatively close in time frame and price to a low that might stick? Another 8% from here maybe, but you'd want those conditions to then reverse, because you can see when those conditions ended at the daily scoring level, we popped back up, we went above the 200-day, and then we went to that long sideways grind. But again, investors need to remember that it wasn't until 2023 that really market turned around and sort of started to be more positive, right? So, and fundamentally, as long as gold's above its own 200-day moving average and rising, I worry less about all these colours anyway. But you're always looking at this thing to say, well, is this turn or is this a correction? Like, I don't buy into a 20% move as a bear market versus a bull market. If a market's got a positive uptrend, it's in a bull market. And if it's making higher highs and higher lows, it's a bull market. I don't, when I first started working, I didn't think anyone had a percentage setting on bear markets, but now people go, oh, it's fallen this far, it's a bear market. I don't agree with that, but I certainly think gold's still in a bull market, but we're certainly in a pretty strong corrective phase. And if the dollar keeps going higher and gold continues to struggle against equities, that could deteriorate. And if this, at a weekly score, we start to get red there under the 200-day moving average, I'll be quite nervous, because that's not a situation that you would generally expect in a if this is as healthy as it sort of seemed up until now. But because it was so extreme with that death zone, you got to expect it goes more one way, it's going to go further the other before it reacts. That's just the way markets work, right?
So is the SAFER traded pretty sideways now from $4,000 an ounce? When do you think it would actually cross the 200-week moving average?
Oh, it will be, for the 200-week moving average to actually get up to the current price level, if we trade at the current price level, I think it's something like 18 months to 2 years.
Okay, yeah.
And so because that...
Because that's usually a big indicator. Like crossing these averages is like, is that what a lot of these big mobs trade off? Or?
I think there's certainly algorithms that use these. They're a lot more complicated than that. But I think, look, if you just look in 2020, around 2021, 22, we went all the way back after 2020 down to 2023. We went briefly below the 200-week, and it looked quite scary, and then it bounced. And then from that point on, the market really took off. But it was almost like it had to get back there to be neutral. I said many years ago when I first started doing presentations when I was at Noah's Rule that fair value is a line that people draw in afterwards between overvaluation and undervaluation, Natty. And I firmly believe that, and that's a very good example. 2011, the market was overvalued. In 2018, it was undervalued. That's what happens. The market gets too carried on one way. You have a mania. It has to correct. Got strong opinions loosely held is the way to look here at the moment. It doesn't look too bad. I don't see US dollar going too much higher, but if it does, we've got to be very mindful of that.
Yeah. So you're saying that's about to switch back to pretty close to switching back to red on the weekly?
It's literally on a knife edge, because I think both the weekly score and both the elements are inside -1 and +1. So if equity started to correct, that would be all right for gold if gold holds. But gold slips too much more and the US dollar stays strong. We could have a red background there, and then it's going to look a bit more like 2011, or it's going to look like it did in 2021, 22. The more important thing is what's actually happening to gold score itself. So if you flick on, these are looking at the Dow Gold alongside gold and with ETF balances to maybe give people a better idea of why I do put a lot of faith in it. Up the top, there's our US dollar gold price since 2006. Green background's very positive. Above the 200-week, the red line, you've got a nice bull market we had from 2006 to 2012. And as I said, it was in 2012 when equity investors went, don't need to own gold going back. Go down to Dow gold ratio, you'll see it turning from red to green, crossing up through its 200-week moving average. And guess what? The ETF balance is down below, which is pulled together from, I think about 30 different ETFs around the world. ETF volumes had been rising. ETF rising volumes is basically institutional investors buying the gold ETF to put in their portfolio, and that started to reverse. And it reversed for the entire period. Gold was falling. And if you look at that red band on the bottom chart and the red band on the top chart, they're almost identical, right? Like gold was falling for the entire time the ETF balances had a negative score. And when it turned around, as that Dow gold ratio started to flatten around 16, things improved. But, gold did not do well, struggles to do well when the Dow gold is rising. And I put a circle over there in 2006 to show where we had a couple of times there on the Dow gold, Maddie, where that black circle is, where the Dow gold rallied, weekly score turned positive, but we never got back above the 200-week moving average. So they were like bear market corrections, like it's trying to go. And that could be what happens here. We could get a green line here. We could get a little bit of positive weekly score, but it's going to depend on what happens to the ETF balances. But, the ETF balances have been flat, as you would expect. In fact, they've been falling a little bit. And as a consequence of gold, and with the market still strong, the Dow gold ratio is rising. But it's still rising in the context of, I think, a correction against the longer-term downtrend that started in 2021.
And because this is like, very related to the gold price, and you've said yourself you've pumped the gold equities as well. And you look at, if we just did very simple maths on the fact that if it does trade sideways from this period in a range of, let's say 3,500 to 5,000. But God, you remember 2 years ago when companies were claiming that they're going to have underground mining all-in sustaining costs of $1,200 an ounce Aussie, and now there is not many that are actually in the 2,000s for all-in sustain. Costs have just gone through the roof. How are you looking at actually gold equities and thinking, where is the value in gold equities if we're going to have a bit of sideways gold movement with all the mines that have been created, all the workers needed, and just costs going through the roof in the past few years?
I think, production discipline is obviously going to be important in terms of, the miners don't start cranking production too much more, because in a period of time where no one feels the need to necessarily buy gold, but producers keep on selling it, they're their own worst enemy, as we talked about before. 58 ounces above ground for every ounce going to be produced this year with the world stock. So, but I look at it as from an investor perspective and have a long-term with the companies that I hold for the long run. Even if the gold price trades sideways in a range 10% below here, back to halfway to the high, Maddie, if that kind of working hypothesis of trading sideways like the 2021, a lot of companies are just going to keep making shed loads of money, right? And you look at the bank balances of many of these companies now, the $1 billion plus cash and things like that. So, they've created a lot of cash in the last little while. And what are they going to do with that cash? They're going to start paying bigger dividends to encourage people to stay on the register, to do buybacks. I don't know, but I think mining companies have to be increasingly aware of trying to keep people on board and keep them sticky until the price starts running again. Because one of the biggest mistakes that I see CFOs and mining executives make when they stand on stage is always talking about this, we're a geared play on gold. So the minute that people decide the gold price is not going up or it's going sideways, people just go, well, you told me you're a geared play on gold. Gold's not going anywhere. I'm going to go and buy something else. And that's where I think Bill Beeman really distinguished himself in the early days of Northern Star, and Jake Klein continues to do. He said, we're in the business of making money for shareholders. And Jeff Quartermain at the Perseus under Jeff, and now with his successors, they're in the business of making money, and how they make it is gold. Companies who talk about we're in the business of making money by mining gold, I think they keep the stickiest shareholders, if you know what I mean. So I tend to try and gravitate towards those companies as an investor, because I think if the price just trades sideways, a lot of those shares don't reflect that. I think the broker's consensus prices aren't around current prices, right?
Well, I suppose some of the big names in our ASX sector, like most of them are actually expanding to lower costs. Like, you know, Northern Star, KCGM, Genesis, they're going to be a much lower cost producer now with the merger. You know, Evolution's done their expansion. Westgold's going to be expanding mills. Orobanda's expanding, Ramelius is expanding. Like, so I guess that in that higher cost environment, if it does trade sideways, it's the ones that are going to actually have lower costs in 12 to 18 months' time.
Yeah, and absolutely. And I think, you know, I just don't know why these guys. Well, I do know why they're not hedging at the moment, because you get into a cycle where it goes up, everyone's got out of the money hedging, everyone gets embarrassed, they spend money to buy back. You know, the sad thing is, Matty, and it's a bit of an indictment on the industry overall, and certainly many of the very vocal fund managers and brokers who sit around the periphery of the industry, more gold hedges were bought back above 6,000 than were new ones put on. You know, the gold mining industry actually bought gold above 6,000 to meet the needs of the market, and more of that was bought back than was sold. And that's, to me, that's a shame, and that's a missed opportunity. And we've certainly spoken about that in the past, even just trying to convince clients late last year to sell enough gold to hedge their fuel because the gold oil ratio was so high. The general feedback was the institutional investors just do not want to hear about any forward selling, and we're going, well, selling 4% of your gold to cover all of your oil is hardly, you know, like no one's going to be angry at that. But it was just, there was this feeling. And I think part of the reason, Matty, is because so few people control so much of the money that goes into gold mining companies. You know, there's not a lot of gold only funds out there. So those guys seem to dominate the agenda.
So when gold like briefly hit sort of 7,800 Aussie, what instruments were available? Like what put options could have you sold then at that price? Considering we're back below 6,000 bucks Aussie now, in the 5,000s, could have people actually hedged themselves against this and be in the money?
Yeah, absolutely. Well, the first thing they could have done is they could have forward sold, and they would have been earning the prevailing price plus about 3% a year of contango at least. So, you know, there'd be people that could have forward sold and got, you know, 8,000 plus, you know, 1 year out or less, right? And puts up until when you and I were chatting, Matty, around the time that you and I were chatting, 3 months before you and I were chatting last, we were recommending people buy puts, and they were quite cheap because everyone was looking up. The minute that we dropped out of that death zone, all of a sudden every institutional investor in the world seemed to be wanting to buy puts, and puts became very expensive. And we had a situation where on the way up, Matty, like people when Aussie dollar gold got to 6,000, you could buy a 5,000 put for a price, and then it got to 6,200 and you could buy a 5,200 put for the same price. And you know, for the budget you had, and I don't remember what the prices were at the time, but you know, if the price went up $500, the put you could buy for the same money went up 500. And then right towards the end, the price went up 1,000, and the option you could buy for the same budget only went up by about 100. And that's because the volatility, the implied volatilities went up. So if you want to buy puts, you have to be buying them before the market goes nuts at the top. You really have to kind of be buying the way up, and very few people did. And then, of course, once it starts falling, it's very difficult for people to forward sell, because they go, oh, I could have sold at that price yesterday, and you know, we've seen it drift off a long way without really anything added in any major way.
Could you imagine if one of the main producers forward sold at 7,800 bucks an ounce, a considerable amount of their production, and how bloody genius they would look now? But but Jesus Christ, it'd be a punt.
Well, but Matty, this is the thing. So this is a very important thing. It doesn't have to be a large amount to be meaningful. We had lots of conversations with people saying, why would you not do 10% or 15%, 20% for the next 2 years, and think how good it would be to be wrong? Do the numbers and figure out, like, you know, but everyone's going, oh yeah, but you say that, but you would have said that $1,000 ago, you know. And so it's that thing of like, everyone, it's the risk of being wrong. It's the risk of being seen to be wrong. But yes, it would give people enormous leverage right now. And, the reality is it's still available to people, and into rallies in the next little while, we would still be recommending people, to be thinking about where it is, because unfortunately what tends to happen, Maddie, is the market goes down another 10% from here and people start to rerun their numbers and realise how their costs have gone up, and then maybe oil goes up a bit, and we'll probably see hedging again, because I've always joked that hedging gets done on the yelling up beach house to school fees cycle. So on the way the gold price is going up, everyone's going, don't hedge now. My options are nearly in the money. I want to buy that house in Yell. And then it gets down the bottom and the manager director walks in the CFO's office and go, I got 3 kids at private school and, a great big mortgage. We can't afford not to make money here. We need to lock in some hedging. So unfortunately, a lot of hedging tends to get done in those red bands.
Yeah.
Where people are feeling the stress.
Hindsight's a great thing, but the whole, when gold was ripping like it was, and it happened quickly. When you look at how long these graphs are, it happened very quickly.
Yes.
But everyone was marketing themselves as an unhedged gold miner.
Yes.
Like, you were penalised in the market if you had hedging of any. And they're thinking, well, if we hedge now and it keeps going, we're going to get penalised in the future. But okay, so if that's what the smart hindsight thing you would have recommended at that price, then what do you recommend to clients now when gold's sitting at about $4,000 an ounce?
Well, we sent out a note today to our clients, Matty, again trying to encourage them to look at how many litres of fuel you can buy for an ounce of gold, or how many, how many thousands of litres you can buy for an ounce of gold. And that idea where we said if you're burning 20 million litres to produce 100,000 ounces of gold, which seems to be, looking at a couple of companies, that's sort of a metric. For about 2% of your production for the next 2 years, you could forward sell 2% of your gold for the next 2 years, and you could then hedge 60% of your oil at current prices. And the prices are very high in the nearby, but once you get down the curve, they're not too bad. And they are 90% of all the price experience. In fact, 95% of all the price experience the last 20 years is below the ratio that you can lock in. So, if you're fearful about not wanting to lock in gold, but the idea that you'd say, I'm going to pay for my oil in ounces of gold, or pay for my diesel in tons of copper, and we've been on this bandwagon for a while, Maddie, but that's one thing I think all mining companies should be doing, because it's a very, very when you're at that level, like I look at at the gold oil ratio, go right to the end quickly because the chart's there. The only other time that we've ever had that you could buy so many barrels of oil for an ounce of gold is during COVID. Now in COVID, we know, Matty, why that ratio was like it was. Nobody was driving anywhere. No one was going anywhere. At the moment, the world's, very, very different to what it was in COVID. We know why the oil price has been affected. But before Epic Fury, we were already up here at these levels. And I look at that, and you look at those long-term averages, 40-year is the red line, 100-year is the black line. I don't think the world's changed so much that you can't imagine that ratio couldn't go back to where it was on average in the last 40 years, or in fact, even the last 10 years, which is way down in the guts of below 30. So one of the reasons mining companies are so profitable at the moment is because they've never had to produce less gold or less copper to pay their fuel bill. And that's one thing that you can do here, because if you think that ratio is going to resolve to somewhere near the black and the red chart, you have to believe the gold price is going to halve. Remember, it did in the 70s, or the oil price is going to double. Now, I wrote in our note to clients today that, Trump talked about, when this war's over, oil's going to go to drop like a stone, $55 a barrel. Well, you're not drill baby drilling at $55 a barrel. There's no incentive to produce in America at that price. And I saw a great line, which I was just trying to find here, is, the deferral of consequences is often confused with the absence of consequences. And I reckon they've kicked the can down the road pretty well with all the jawboning and all the releasing of the stocks here. But if you had to make a bet that what's more likely to happen here, oil to double or gold to half to resolve that ratio, my money's on it's more likely that oil doubles than gold halves, given everything that's going on in the world. But you shouldn't write off the fact, the gold price can halve. Of course it can, or some combination thereof. But I do believe that ratio is out of sorts. And in fact, I said to you when we chatted last time, I was selling gold stocks to buy energy stocks, and to buy broader mining. That was my hedge, and I bought BHP. If you look at BHP, Develop, oil stocks have probably gone sideways over the 4 months since we chatted. Develop and BHP have both gone up. Wire, the copper ETF's probably gone sideways. So you'd be much better off to be in those things than suffering 20, 25, 30% losses over the last 4 months in most of the gold stocks, right? So, but this ratio, this is the thing that confounds me the most. And as I said, that's what we recommended to our clients today. Hedge enough gold or copper to hedge as much oil as you can, pay for it, in valuable output, and just remove that volatility from your bottom line and lock in profitability or margins between metal and oil that have not been seen in 95% of all the history.
So what's the mechanism to do this? You're saying effectively now they should be buying as much fuel as possible at these prices. Are they forward
sell gold? Say forward sell some gold to the end of every quarter.
Yep.
And the dollar value of that gold, you would sell enough dollar value of that gold that was the equivalent to the dollar value at the oil price that you could lock in for that same period.
Yeah.
And so if you're burning 20 million litres to produce 100,000 ounces of gold, it's about 1.8% of your production to hedge 60% of your oil for the next 3 years. I just did it in a note that we sent to our clients. So, and I would probably go 80, 60, 40 over the next 3 years. But that, so 100,000 ounce a year producer, and you're hedging 5,000 ounces of gold, Matty, over the next 3 years. It's a rounding error, right? Yeah. So, but that's, I think, is something that you can do that is a very good thing, just to de-stress your business, because costs are rising, and that ratio suggests to me that the greater risk is that whatever Trump says, oil prices are more likely to go up than go down. And if gold price falls dramatically, well, at least you've locked in still a good margin on your operating costs. You're still going to suffer, but that's a different issue. I mean, I would be hedging some gold as well. I don't know why, as we came down between 7 and 6, we didn't see more people just locking in a modest amount. But I think it is that thing that sometimes people think, if I only hedge 15% of my production or 20%, I'm just going to attract a whole lot of negativity. Why would I pick that scab off? Like people think you have to do big, or to your point earlier, you have to do big or nothing. It's not true. A modest amount can still make a very big difference, particularly relative to your peers if we did have a bigger sell-off for some reason.
Yeah, and with the interest rates wise, I know you said you undersell how much you know on the macro, I think, but interest rates wise, usually higher real rates is the headwind for gold, but gold actually ran hard into this environment. Is this textbook version of higher real rates being a headwind for gold sort of broken now or not?
So the dual tailwinds, dual headwinds thing, it doesn't look at any way in interest rates, but interest rates clearly impact the dollar, and they clearly impact the stock market and people's preference. So I don't, it's just another leg you could add in. It's just like one leg too many for me. So I choose to ignore it. And I think when gold broke up through the range out of 2023, all the real rates guys were saying gold was wrong. And we were saying, well, the market's right. So something else is happening. And then we got the dual tailwinds again, and we went, well, no one cares about interest rates. So I think in the long run, clearly the cost of carry is important. But in the 1970s, again, interest rates were rising right through the 1970s, Matty. And for a little while there, they were convinced in 72, 73, they had inflation under control. That's why the gold price halved. But then the bond rates took off. I mean, gold price rallied from 100 to 800 in a period of time where US interest rates went from 9 to 20 or something.
Yeah, wow.
And I think that interest rates are more likely to go up than go down. That's as much of a macro view you get out of me, simply because people are believing governments are going to print more, Matty, and if they're going to keep printing more, and I think something now, like I saw a chart somewhere today that, between interest rate and entitlements, that's where 90% of the US income now goes. So, and then where are they funding this war? It's just more debt.
Well, a lot of shit to replace.
Yeah. So just quickly to wrap up then, mate, because I'm conscious we've been going for about an hour now, mate.
Perfect with me, mate. I love talking to you.
This is gold on its own, right? So this is the most important thing. Green background above the 200-day moving average is the best. Green background between the 200-day and the 200-week is okay, in the scheme of things, and that's where we're at. But you can see there before that's 70 to 80%. What that's referring to up the top is that the last 3 times we ended the three longest periods of continuous weekly score, we had 265% move beginning to end at the high of the period, but we're only up 210% by the end. The next one was we're up 120 at the 9 at the high, 94. So those moves, the eventual moves where the background turned red, were 70 to 80% rallies. Okay.
Yeah.
On that basis, if we finished now, gold, that would be 4,600, 4,200. So gold's already well below that. So this is already potentially, hasn't ended yet, to be fair, but would already be a bigger retracement than we saw in those last three significant periods. And this is now, it was 167 weeks, I remember, only because I rewatched it quickly when you and I spoke last time. It's 187 weeks now. So now this is the second longest rally, and it's by far the second biggest rally at 194%. But it's nowhere near as significant as the period from 2001 to 2008, where we went 375 weeks and rallied 265%. So if this keeps on keeping on and we don't, print into negative weekly score, well, this might be very much like the 2006. The 2006 high is the closest cousin to this rally at the moment that we have in the recent history, right? And if you think about that, are we a couple of years away from a GFC type event, SpaceX and all of these? It does feel like 98. It's felt like 98, 99 for a very long time now to me in the equity market. But, it does feel like, we're bubbling, but we haven't yet rolled over. People aren't willing to give up on the broader equity markets.
And
but,
how do you feel about similarities to that, I guess, that tech bubble, compared to now, just the fact that the stuff that is getting created, I am using it, I'm living on the stuff that's being created, I guess that tech bubble previously when anything with a .com would just rip. How do you see any rhyme or with that?
Again, overvaluation to undervaluation, right? There's brilliant things being created right now. This is one of the most exciting. I mean, I'm sure it happened when people first started flying too, right? But this is an exciting time to be alive, and I find it just incredible what people are doing from that side of things. But, I think people that are older than me or better historians are saying it's a bit like the railroads. Everyone invested in the railroads, and the railroads are fantastic, but we built too many railroads, and so railroad stocks fell to the floor. And, Sun Microsystems and some of the darlings of 2000 fell 80, 90% before they bottomed and went up, Matty,
Yeah.
So gold is still, it's not crazy. Is it like 2006? Is it like 2008? I'm not willing to give up on gold by any means. There's no sign. This is a healthy correction. I wouldn't like to see dual headwinds. I certainly wouldn't like to see dual headwinds at the weekly level, but that might be it. If you flick quickly to the Aussie dollar one, mate, the equivalent of this, you'll see a lot more red more regularly, and that's just the interaction of the exchange rate and gold, right? I mean, that's the reality of it. And as you and I talked on last time, this is a very long period now. This is the longest period since 2000 of continuous weekly score, positive green background for $8 gold. We've been going 196 weeks. We've rallied 186%. So we've gone twice as far in price as the next largest rally back in 2007 to 2009 when the $8 collapsed during the GFC, and that's what pushed that spike in 2008-9. That was the middle of the GFC when the Aussie dollar totally got poleaxed from 98 to 60, and Aussie dollar gold went through the roof. And we hedged right into the high of that for Catalpa. It was great fun. That was the first Edna May hedge. But but forward sales off that plus contango, they were in the money for years and years and years. And you look at the spike that we've recently had. Yeah, it's a shame people didn't take advantage of it. But look, 8 weeks from now, 10 weeks from now, 2 years from now, people say, lucky I didn't sell it high. Who knows, Matty? But look right down the bottom of that chart. You'll see how quickly the weekly score is dropping off. I wouldn't be surprised to see the weekly score get into small negatives here and to put a red line on this Aussie dollar chart, and that would not be unhealthy. I think, again, given how far we are from the 200-week, given where we are in the broader scheme of things and what we've discussed, that'd be a nice, healthy correction. And if you look back in the 2000s, waiting for those red periods to end was like the starting gun for every great rally. If you look there, go through a period of that. And one of the things I did notice, and I think this is a good way to maybe to kind of wrap up, the sentiment. I saw a sentiment indicator for gold the other day for gold equity investments. It was at the lowest level ever recorded in the time that they had put this index together. So, the sentiment has never been more negative by this measure for gold equities than right now. And yet I look at it and I go, well, that's a good thing, right? Because the only people invested in gold equities at the moment are gold nutters, really. I mean, the broad equity market they're really not involved, other than those index people that were forced to get involved because of all the companies that have recently gone on to the various bigger indices, right?
Yeah, and a lot of people become gold nutters in the last year.
Well, I think they have. I mean, they're queuing up outside Martin. Well, we didn't see in the gold equities to the same extent we saw all the people queuing up outside Martin Place, the ABC, to buy gold coins. But, so look, we put a red background on here on the Aussie dollar thing. That wouldn't be surprising. My biggest concern for our $8 clients is we go through a period of time where the $8 outperforms the gold price. And I talked to you last time about that period from 2001 to 2006, where US dollar gold went up 70% and $8 gold went sideways because it was matched. Now, no one can see that coming at the moment. No one can imagine that. But if the US dollar fails above 100 here, we come off the back of epic fury, dollar starts to fall, we get a big commodity boom as everyone starts to rebuild. It would be perfectly logical to me that at some point in the future we have a period where both gold and Aussie are rising, and I think Aussie has the capacity to match gold as we saw in the early 2000s. Potentially. But, that's always Bill Reppard used to refer to me as the Prince of Darkness because I'm always trying to find out the things that are going wrong. But that's as an investor, you should spend more time thinking about what could go wrong than what could go right. And as a professional risk manager or helping people manage that kind of stuff, that's absolutely, we start from that. Frame,
you would have been the Prince of Legendary if people listened to you and they sold some gold at 7,800. So...
Well, look, but, we started to say it made sense at 6.5. And of course, that's the problem that people go, well, but of course, by now that would all come in. But we've been surprised by how quickly it's fallen. Even in our short-term selling advice, we really haven't got ahead of this just by the virtue of what it is. But again, you got to be in the context that at the moment, this is a correction in a what I believe is a strong uptrend. And there isn't enough evidence yet, Maddie, to believe that, the high we saw is the high that we're all, we're going to look back like the 1980 high and go, oh, wow, that was it. Yeah. I mean, that I don't think that it's reasonable to have that view yet. But, for producers, they take their costs up too high. That's their biggest risk. They need to have freeboard. They need to be able to have a buffer here.
Mate, last question. You had a pretty good understanding of who was buying the gold going up with the debasement and coming out of US dollars going into gold. More buyers than sellers. In this down leg, who do you believe is driving the selling?
I think who's driving the selling, or is it an absence of buying? I had that line I said to you last time, gold producers, the biggest issue that you have, mining companies full stop. You go through periods of time where your customers are your competitor, and where your customers are your competitor. So, institutional investors buy commodity indices as inflation hedges, institutional investors buy gold, and they're your customer. And then they decide there's something more interesting, like in 2012, Dow Gold ratio starts going up, and then they're your competitor. And they are far more, I think they're far more disciplined and far more quick to act than gold mining companies, right? So when we saw the change in Epic Fury, people just went dollar stronger, bang, I'm out of my long gold, right? So they're selling in competition with things. Central banks slow the rate because you're a bureaucrat. All of a sudden, instead of gold going up all the time, gold's fallen a bit. You're going, well, maybe we should slow our buying program. I don't want to get sent to the gulag. And so you've got all of that stuff going. So I think it's, at the moment, it's an absence of buying. And the problem that you have for an unhedged gold producer is, unless you want to accumulate gold, and I don't think it makes sense to accumulate gold, certainly not in this type of price environment, you've got to sell every week to pay your bills, or you've got to sell enough to pay your bills. Gold producers come every month, and then every quarter end they oversell. we see it. They squeeze. You know what it's like. Your mates, you had that funny where you got your mates on the Cairns one Saturday, your jumbo driving friends, and you were talking about mining. And I'd laughed when they talked about how at quarter end, the blokes upstairs start wanting you to pump extra production out to make the numbers. And then you spend the first couple of weeks of the new quarter trying to amend everything you messed up, right? We see that writ large on the price. And we said to our clients, like, if this price doesn't now rally in an absence of selling early in the quarter, that's probably a bad sign. And we've seen no absence, we've seen no let up in the sort of price coming off. So absence of buyers, I think, is more the issue than necessarily wholesale selling. The buying, the people that need to buy or feel the need to buy at the moment are not as much as the gold producers need to sell week on, week out. And that's where hedging comes in really handy, right? Because producers, if you've got hedging, you don't sell. You just deliver into your hedge and you're not contributing to the fuss. So I think it's more an absence of sufficient demand to meet to create enough bid for the producers. And we're going to keep drifting off, I think, probably till we find that balance. And our scoring suggests that might need for us to have a brief period of negative prices. The sentiment is much more negative towards equities than it is towards gold, which I think is good, because when it turns around, that'll be really the time to probably get back into the gold equities space. But I think the best hedge I've found, Matty, is to be in parallel spaces. Gold was overvalued relative to general equities. It was overvalued relative to copper. It was overvalued relative to oil. So, some of those things have gone sideways to up while gold's gone down, which kind of keeps your portfolio whole. But long run, I remain a believer that commodities as a asset class remain radically undervalued relative to general equities. And coming back to your .com thing, or the AI thing, if all of that's true about AI, there's not enough physical material being mined and produced in the world to meet all of their needs. So we've obviously got to find some middle ground, right, where we've got to produce more material to make all the things that they believe, but we're never going to make enough in the time frame for them to do it. So they're overvalued, and they're probably going to come to undervalued as we come from undervalued to overvalued, and we'll pass somewhere in the middle, like two people on the opposite escalators at the shopping centre. And I'd rather be on the one going up than the one standing at the bottom of the one going up than standing at the top of the one going down, mate. So I'm sticking with commodities.
Would you ever recommend, if gold dropped to 3,600 US and everything was lining up, that you might be coming out of the end of this channel period, or that's a low, would you ever advise a client with a very healthy balance sheet to store gold?
Look, I'll tell you a funny story. And you had him on the show a little while ago, John Wellborn, who I've become quite, good mates with, and he's been a client a couple of places, and Phoenix is a client. When he was the managing director of Resolute back in around 2014, and when our scoring was like absolutely on the depths and it made sense, he stopped selling gold. Yeah, and he said to the market, we're not selling gold, we're using our cash, and we're doing that because it's kind of crazy. Like, all that effort to go in to produce it, why would we sell it here? And I didn't know John very well at the time. I knew him in passing, and I went up to him at Sydney Mining Club and I said, don't disagree. Our scoring is like -4. If you're ever going to do it, that's the right time. But what's your plan B, mate? Like, when are you going to sell it? I said, because the market's going to hate this. I said, as much as you are doing the right thing, and these guys are all full of shit, like these analysts, like they'll go, well, how do I value it? What do I do? And it was fair enough. That's exactly what happened. People go, oh, we're not sure about that. And of course, then you're becoming a chief executive of the mining company. Everyone's going, well, why are you selling now? Are you negative now? The market's not kind of set up to do it. So yeah, if clients came to us when our scoring was at near double negatives, like the complete reverse of the thing, if they had the cash balances to do it and wanted to accumulate, we could help them develop a plan. But ideally, what you would do, Matty, would be if you had hedging, that's the time, like in 2014, companies were there, 2015, saying, look, if this goes any lower, I'm going to close out all my hedging because I can buy gold cheaper than I can produce it. We would never tell producers that to buy gold cheaper than they can produce it and deliver into hedging higher is not a good idea. Paying more than twice what you can produce it for to buy back the hedging to keep the market happy, people have done that, and look what happened. Like, people did what they thought the market wanted, and it's cost their shareholders money ultimately. So, but I think, if that thing was covered in red and both those lines down the bottom were near the bottom of it, if you were ever going to have a go, that'd be the point. But assuming you've got enough cash to pay your bills, Matty, because that's the other side of it,
Which
right?
Some do at the moment. Plenty do.
I think as gold producers, you're much better off to sell into strength and then deliver in than start trying to get to the long side. You're long enough, mate, really, at the end of the day, right?
Yeah, right, mate. Well, that's been sensational. And, mate, whether my endorsement means anything to the world or not, I don't care. Any gold producer should be heading your way for a chat, because you're an absolute expert in the industry, and I could not recommend you enough. As I said, whether that holds weight or not, whatever, but it's very true from my
holds
world.
weight with me, Matty. Thank you. I appreciate it, mate.
Nah, awesome, mate. Thank you to
see
you
you
and the
Noosa
team.
next week.
I will, mate, and thanks to everyone at Noah's Rule, including yourself, that's developed all this stuff that on Showcase today, mate. It's been very, very informative and entertaining.
Oh, good stuff. Thank you, mate.
Thank you, Shawnee. Thanks,
See
mate.
you soon. Bye-bye.